All right, so this is life insurance. It's not very exciting at all, but I'm going to do my best to make it exciting. One second, let me get my notes up. A lot of people don't know about life insurance. It's very, very tricky, and that's why I have today's class. It's also huge in terms of estate planning. Okay, I'm going to show you that. You're never too rich to not have life insurance. Everybody needs it, and I'm going to show you why. Okay, first thing I want you to do is realize that life insurance companies are highly profitable. Highly profitable. You're not getting over on any insurance company. Okay, they're not cutting you a deal. They're not doing any of that. If you have all these bunch of reasons that your life insurance policy is going to be profitable, that you're just repeating what the salesman told you. That's it. Okay. So, what is insurance? Let's get to the basics. What insurance is you got a risk. You pull that risk with other people. The insurance company assigns the probability to that based on what their payouts are going to be, and then they charge you based off that. Okay, so the risk is here in this case is that your life ends abruptly, and one, you don't want that to happen to, but two, that's going to be absolutely catastrophic. Okay, which is why you want the insurance. Okay, people say I got insurance with no health screening. That's the absolute worst thing you can do. Okay, because what the insurance company is going to do is they're going to average your risk according to the worst possible um, risk profiles that are in the U.S. or in the group that you're in. So whether you're in a church group and got life insurance, or whether you're an employer that got life insurance, again, go back to life insurance companies are highly profitable. They're not giving you something for nothing. Okay, if this is extremely cheap, it most cases it usually is. That means the risk that something happens to you is extremely low. Okay, and what ends up happening, and I've seen this a lot of times, is they'll get these insurance policies with your employer. You get sick, you get in a car accident, something like that, and you lose your job and stop paying premiums long before your life insurance ever pays out. Okay, so this is free money for insurance companies. Okay, group life insurance. If you want group life insurance and it's super cheap, then do it to as a supplement to what you're currently doing. Don't let this be your only plan. Yes, it's easy to sign up. Yes, it's cheap, and there's reasons for that. Okay, it's just free money to the life insurance companies. Okay, what you want to do is you want to base the insurance on you, not the obese people, in America, not smokers, not everybody, with all kinds of health issues. You want it based on you. You do push-ups, you do sit-ups, your BMI is good, you don't have high blood pressure. Get the health screening, get it on you, and that way they can't lapse you. Okay? They can't cancel coverage on you. They can't do any of that. Okay? And there's a misnomer saying that life insurance won't pay out if you commit suicide. That is also a misnomer. If you don't have depression or you don't have never tried to commit suicide and you get approved, there's a 1 year contestability where you may have committed fraud. You lied to them. Okay? They have that right to say you lied to me. I'm not going to pay it out. But after that contestability, yeah, you could have got PTSD. Something could have happened. You could have gotten in a car accident. You could have lost loved ones, and that precipitated depression. That precipitated you trying to end your life. That is what the insurance is for. Don't let the movies trick you. You can develop depression after you get the life insurance, and that's part of what they're covering. You were healthy minded when you got it. It's not just physical. You're healthy minded and physically healthy, and they covered you for both. So don't let that deter you from getting the insurance. And I don't want anybody to. Okay, that was maybe bad. But anyways, let's go to this couple here. Okay, this is one type of couple. This is what a lot of soldiers are in. They have a bunch of kids. They have a wife. They may have their own income, just maybe one income. You're scratching the bottom of the barrel, right? You're scratching for every penny, but you need life insurance because what ends up happening is something happens. You maybe get injured, maybe get in the hospital, maybe lose that income and pass. That family is now in dire straits, and they will be for 16 to 18 years. So this is where you get the cheapest basic insurance that you can. Don't let the salesman talk you into, hey, if you start now in a permanent policy, you'll have $1 billion by the time you're 90. Don't buy into that. Don't get life insurance policies for the kids. Don't get any of that. Okay? Get the cheapest policy possible that covers you. Anywhere from $200,000 to $1 million. Cost you depending on your health, anywhere from 20 to $40 a month. Treat it just like your car insurance. If you don't need it, good. You paid the premium, okay, to cover you. Treat it just like a bill, just like car insurance, just like any other insurance. That's just the premium you're going to pay for that time frame, okay? And the reason for that is put your money towards mortgages, put your money towards, investments, maybe college, and you're covered if anything catastrophic happens. Okay, and we're going to go into why that is. So here's what premiums look like, or the cost of insurance. Okay, cost of insurance goes up every single year as you get closer to passing, as you get closer to life expectancy, 87, 89, whatever it is, it fluctuates. Closer you get to that, the higher the cost to cover you is. So what term insurance does is it says you want life insurance for 20 years. We're going to level out the premiums for you, and then you pay one level premium for this entire time frame. If you want just 10 years, you'll pay this level premium. 20 years, or this 10 years, you pay this level premium. This 10 years, you pay this level premium, and so on. If you want 20 years, then they just average these two together. Okay? Now, the later you get the term life insurance, the more expensive it's going to be because you're covering years where you're older. So, what I typically do is I tell people don't get life insurance for your kids because they are, like I said, I did life insurance for a long time. What they do is they give kids worst case scenario. They give them standard smoker rates at their age. Don't ask me why. They're covered under standard smoking rates. You could only get whole life insurance or a UL maybe, and you're going to get them very low amounts, 10, 25,000, not going to do very much. So at 18, get them that health screening, get them locked in to a cheap term policy that they could cover, $20 a month, and have it be able to convert to a permanent life policy. That's the best thing you could do for them because now they're always going to be that healthy 18-year-old in the eyes of the insurance company forever and ever. Can't cancel them unless they stop paying. Okay, you're always going to be that healthy 18-year-old that ran a 4440 or whatever. Okay, so that's the best thing in terms for kids is get that life insurance policy earlier. And for a family like this, like I said, get the cheapest one possible. Don't let them talk you into a permanent policy because how the permanent policies are structured are going to be very, very expensive, and they're going to give you a lower level of coverage. So $100,000 in term insurance is going to cost pennies on the dollar, whereas $100,000 in permanent insurance is going to cost a boatload. And I'm going to show you how those are structured here in a second. So the chances that you pass down here are 5.6%. That's why it's so cheap. It nearly doubles as you get older. So this will exponentially go up and up until there's literally 100% chance that you pass. Like at 87, 86, they're charging you huge amounts of premium. So that's why you typically get it early, get the term early, and then have it converted to permanent. And I'm going to get into the structures right now, but this is just a little bit of estate planning, and I'm going to show you the difference in terms of how that works. Now, when your insurance, when your risk changes, change your insurance, right? If you don't have a house anymore, don't carry house insurance. You don't have a car anymore, don't carry car insurance. Same mentality. This couple is in a totally different situation, right? They have the house, they have the cars, they have the money, they pretty much have everything, right? Now somebody would say, you know what? I don't need life insurance in this particular case because they have plenty of money and they don't have any kids or anything like that. I have my will put in place. Everything's good, right? Well, I've seen it hundreds and hundreds and hundreds of times. Maybe I'm exaggerating, but I've seen it takes a long time to get stuff through probate. One. Two, the money that's in the checking account that you're going to use to pay all your family's bills, that's not your money. That is the money of the beneficiaries. If you are a beneficiary and you're handling the estate, you have to separate those duties. You can't just say, this is my money, I'm going to start spending it to pay the bills. That's, you're going to get in trouble that way. Okay? You have to separate yourself, one as the executor managing, two as the beneficiary sometime when the probate is finished. So the money that's in the checking account that was your dad's or your mom's, unless it's a joint account, it's not your money. Don't use it. That's what life insurance is for. Okay? Life insurance is outside of probate. Life insurance, for the most part, is outside of the estate. That money, whoever it goes to, that it's their money. They can do whatever they want with it. So what I usually recommend is whoever's going to handle your estate, whoever's going to pay all the bills, get all your apartment stuff sold, auction off the car, whatever, all that crap that needs to be done, make the life insurance policy in that person's name as the beneficiary. So they have liquidity to pay taxes, to sell stuff, to pay a realtor, to pay your bills, or they will be in dire straits. Believe me. Okay? Takes 1 to 3 months to sell real estate. And that's if you, one, have it cleaned up, two, that it's in sellable condition, three, based on the market, four, you want to get what it's worth. That can take a long time. This is 1 to 3 months after it's already in pinpoint tip-top shape and it's listed. Okay? Classic cars take a very long time. You drove around with your grandpa in the classic Mustang and you care for it. Nobody else cares about the memories. They're going to lowball you on it. It's going to take you a while to sell that classic car. Okay? And these are assets that have no money attached to them. You could get money for them, but that money goes to the estate. It doesn't come to you as the executor. It goes to the estate. Okay? Pension continuation, very, very expensive. You could say, hey, I'm getting a piece of my grandpa's pension when he goes, or my dad's pension when he goes. Could cost up to 40%, 45% of your grandpa's pension just to cover you. Not very feasible in terms of cost. Okay, if he's getting $3,000 in a pension, it's going to cost him like $1,300 right off the top to cover a beneficiary. $1,300 a month. That's cost prohibitive. They're probably not going to choose that, and you're not going to find out until they're very close to passing or they already passed, whether you have this pension continuation. When I worked for DFAS, beneficiaries would call up all the time, hey, do I have SBP? Say, nope, he never signed up for SBP because, well, he did sign up and then he canceled it because it was too expensive. And that was only like 12%. So I would not count on that. And again, the continuation money is the beneficiary's money. It's kind of outside of the estate. You can use that in lieu of life insurance to create liquidity, but again, that's your benefit. If you want to use it for that, that's fine. To settle an estate is anywhere from 6 to 12 months. If you have anybody who has settled an estate, it could take years, years, and years. Okay, uh, and this is where the disbursement happens. Court looks at everything, add up everything. You sold the house, you sold the car, you sold the coins, you sold everything. You got a big lump of cash, and now you get to divide it up into all your beneficiaries. Now, what it costs you to get that lump sum of money 6 to 12 months from now could be astronomical. You could have spent $50,000 of your own money to settle the estate. Now, either you're going to owe $50,000 to the estate after you're done, or you could have a life insurance claim that pays out in 2 to 3 weeks. No questions asked. You have a person passed, they get the life insurance policy. This is where the permanent policy comes in place. Okay? Again, like I said, it's outside of the estate. The executor can use this money if you make them the beneficiary. The executor could use this money to settle the estate. The bigger the estate, the more time and the more money it's going to cost to settle. So rich people say all the time, I don't need life insurance. Okay. It's not your problem. It's not going to be your problem. It's going to be your fighting kids' problem. It's going to be your 4 kids that are going to fight tooth and nail over every single thing. Clear all that out of the way. Designated executor. Put the life insurance. Put them as the beneficiary. They settle the whole estate for you. Boom, easy. No fighting. No me having to make phone calls. It's crazy. As soon as money gets involved, stuff goes crazy. Believe me. Okay, so this could be what your executor looks like, because they have their life, they have their kids, everything. They have everything before you passed, and they're still going to have it after you passed. This is just one more thing that they're drowning in. Okay? Stuff you have to pay taxes on. If you inherit jewelry, you may have to pay taxes on it. If you inherit land, you may have to pay taxes on it. If you inherit a car, you may have to pay taxes on it. Okay? Where's that taxes going to come from? Well, again, you could structure life insurance where if you leave your son a $30,000 car, you could give him $10,000 in life insurance to cover the taxes on that. You leave somebody a farm. It's notoriously horrible taxes on farms because they're all land, there's no cash. Okay, you inherit a farm that's worth $3 million, guess what? Taxman is going to knock on your door. Okay? You want anywhere from $10,000 to $200,000. Again, this isn't like term insurance where you need it, your beneficiaries need it. They need the assets. They don't need the life insurance. The life insurance is just to get them the assets. Okay? It's an immediate cash infusion. Yeah, that's supposed to be a coin collector. Yeah, you have to pay taxes on coins you inherit. Okay, so what are permanent policies? Most people have heard of whole life insurance. That's probably the most popular, but it's also the worst. A whole life policy is like a mortgage. Think of it like a mortgage. At age 100, you have to pay in the face value. Okay? You have to pay in the face value. That's it. By age 100, the life insurance company needs to have the face value paid in. So if you want $100,000, pretty easy math. $100,000 between now and when you're 100 years old, that's probably going to be your payment. It's pretty easy. Now they do give you some dividends, anywhere from 2 to 5%. That's going to be guaranteed. They factor that in. and maybe you don't have to pay in the full 100,000. Maybe you only have to pay 85,000, and the rest will come from um, dividends. But again, whole life policies aren't in the market. That's all they get is dividends. Okay, so you have to account for that. Again, if you are that young couple and you get sold on $100,000 policy for the next 80 years, for 80, you have basically an 80-year mortgage. You're going to pay in 100,000 for the next 80 years. It may look cheap now, but opportunity cost. What else could you have been doing with that money? Okay. Yeah. If you want to lend me money for 80 years, and I'll give it back to you in you know, in 80 years, and we can make that deal on the side. But like I said, they're not losing money. Okay. Um, so here is your total death benefit. Here is your cash value. Right here, they're going to meet. So your cash value has to outpace the cost of insurance. And that's where they get the cost from. Okay? If you want to use it for retirement, or you want to use it for the cash value, you are going to have to severely, massively pay into it. You have to overfund this. So instead of this cash value right here, instead of paying it in right here and it meets here, if you're going to use this cash, you're going to have to overfund it so it looks more like that. And then you can use this cash right here because it's over what the face value is. So again, they're not doing anything for you. They're just giving you back your own money. And I explained a few minutes ago how that can benefit you, but in terms of using it as a cash vehicle, I would advise against it. If you overfund it, there's a chance that the life insurance policy could turn into what's called a MEC, modified endowment contract, where it loses all the characteristics of being life insurance, and now it has to be added to your estate. It loses its loses its favorable tax status. So even if you overfund it, you can overfund it too much and mess everything up. This is why I tell people, there's some famous companies that say, hey, I'm going to build you a life insurance policy that you can use for retirement. Yeah, you want to stay away from those. So yeah, this is where the cash value comes from. It's the difference between the funding to get you here and the overfunding that will get you up here. Okay. All right. Let's look at an illustration so you can actually see the numbers. There's my illustration. There's my illustration. All right. Here's my illustration. I believe this is a fictional company, but let's take a look at it. I used an old one because some of them have like bells and whistles that are ridiculous. All right, this was age 30. Cheryl, female, age 30. There's the premium. Initial insurance amount is $25,000. She's paying $373 a month for $25,000 over the next 70 years. Okay, you could probably see right off the bat that that's not going to work out very well for her, especially if she's 30. She may have kids. She may not have any assets. $25,000 isn't going to do very much, and this $373 is probably super expensive. Here is the annualized premiums, and then here's the death benefit. If you look here, surrender values means that's the cash. You could take the cash out that you put in. Most of the time, you can't take any cash out unless it's a loan. You can't take any cash out for the first 20 years of the policy. Some of them are 15 years. Most of them are 20 years. Yeah, it's pretty crazy. The life insurance policy is going up, and that's because she is overfunding it. You can see here she's putting too much in, and so they had to lower the premium so it doesn't lose all its benefits. Here's the guaranteed cash value, which is going to be anywhere from maybe 2 to 5%. And then the death benefits are what's not guaranteed. So they may pay out 7% on occasion, and then they will factor that in, which the chances that they pay 7% for the next 80 years is 0. So these are like your regular numbers, and these are like your overfunded numbers. And what a paid up addition means is if you stop paying, then you won't have to pay up anymore, and you'll still get that life insurance benefit. All right, so you see it's age 100, year 70 of the policy. Cash surrender value is $25,000, and she over funded it, so she could take out $25,000, but her death benefit right now, if she doesn't take out the $25,000, is $88,000. If she does take it out, it'll probably be $63,000. So, like I said, life insurance policies, they aren't giving you something for nothing. Okay. Some of these illustrations, what they do is they'll take the different scenarios. They'll say, we'll do 7% interest. We'll do 3% interest. We'll do worst case scenario. We'll do best case scenario. And then you can determine which one that you want. But the age 100 does not change. You have to fund it till age 100. This one is what's called paid up. She stopped paying at age 48. And then she got a death benefit of... is this the wrong one? No, she's 64 there. She got a death benefit of $25,000 because she stopped paying it. Because she paid in early. She paid in $25,000 way before age 100. So she was able to stop payments and live off of, or it basically pay itself with the interest. I'm going to close that current tab. Now that's whole life. Now, if you took those values, and I know this is a little bit of cheating, but if you took those values and you put in 18 years, for 18 years you would have $205,000 instead of, what did she have? After 18 years she had $25,000 she had paid in. If you did that same thing in the stock market, you would have $205,000 instead of $25,000. If you did it for 70 years, you would have $22.9 million. Like I said, life insurance companies are not taking a loss on you. They are using your money to make boatloads of money just so you can feel good about what you're doing because it's insurance. Okay? Obviously, these aren't guaranteed, but if you're in the stock market for 17 years, I promise you'll have more than $25,000 in 18 years. Promise you. Okay? So this is what insurance companies do, is they give you guarantees, they make you pay for it, because what's the chances you pass? 100% chance that you pass. So it's not really insurance per se, because the risk is 100% chance. So they're just giving you back your own money, and they're using it to generate profits. Not to say it's not needed, but on those very high face values, probably not. Let's do universal life. Universal life is also a permanent policy. It's just structured differently than whole life. The premiums are going to be lower, And the premiums on universal life are lower because they're typically not fixed rate returns. You'll get what's called indexed returns. And I'll go through index returns in a little bit, but these generally your cash value performs better. Um, the values rise and fall with the interest rate, so there's a chance that you could make 10% one year, you could make 2% the following year, then 8% because it fluctuates. Usually, universal lives you can't go negative. You, your cash value won't be like you lost interest, this month or this year. That's not going to happen. It's always between 0 and usually 10%, and it follows something like the S&P 500. Okay, but it's anywhere from 0 to 10%. Whole life is going to be locked in at, like I said, between 2 and 5%. The cash value, like I said, goes off of the market. It does have a fixed component that you can invest in if you want, but typically it's going to fluctuate, and like I said, it grows higher, quicker because of the growth model. Okay, death benefit, it will increase or decrease based off of how the market's doing. Okay, so universal policies aren't till age 100. They're until they run out of money. Okay, so they'll run you illustrations. None of them will be guaranteed. And I'm going to go over an illustration here in a second. None of them will be guaranteed. It'll say if the market does 8% a year, your policy will last until you're 96. If it does averages 2% a year, it'll only get you to age 80. So where it lapses is based on how well it's funded and how good the market is performing. Okay, so these are all typically the same. Surrender charges, they're going to have very similar surrender charges, very similar in terms of annual payouts. You typically can make loans or withdrawals from them at certain points in time. Like I said, the only difference is the age that they go to and where they derive their interest from. Universal lives are, in my opinion, far better than whole insurance, but you do have to watch them. Okay? And I'm going to show you why you have to watch them. So here, it shows your cash value is in the green. It's going up, going up, going up, going up, going up, and then at some point, the cost of insurance is going to be more than what you're making in interest and the payments that you're making. And it's going to start to decrease because the cost of insurance is too big or too high. And this is only projected to last until 96 based off of what it's earning and how much you're putting in. Okay? If you withdraw, let's say you withdraw right here, obviously it's going to fall short. Okay? If you start underfunding it, again, it's going to fall short. If you overfund it, it will go longer, but you will have a chance where you can withdraw and bring it back until 96. So, for instance, let's say I'm paying $200 a month. And I have this illustration. It'll say that I will get to age 96. Good. I'm happy with that. Okay. Let's say I start sending in $50 more. Market starts doing well. I may get my statement that says, it's going to last until age 120 now. Because you've been overfunding it. Market's been doing good. Now you can take withdrawals if you want. Bring it back down to, a normal age. Or you could just keep it at 120, stop paying it, and it will slowly get back into a normal age, because the cost of insurance again will kick in. And every year you may see, okay, now it's going to last you till 118. Now it's going to last you till 116, and so on. And then you may have to start funding it over again. Okay, universal policies, you have to watch them because of how they're fluctuating. Then you may have to put more money in or it'll lapse, or you may have to, get a new illustration because the market didn't do so good. So now instead of 96, it'll only last till 91. So you do have to stay on top of these because they aren't guaranteed like the whole life policies are. Let me show you an illustration of this, and I think this is a real company, but these are a little more complex. It tells you how amazing the company is. All right, this person it's a joint, age 60 and 53. They got preferred plus non-tobacco, which is, if you're 60 and 53 getting preferred plus non-tobacco, you are probably running marathons and winning, because this is right when all the bad stuff starts happening. All right, so they did $3 million. Their premium's $50,000 a year. They're going to pay in for 10 years and then stop. All right, so here are the different strategies that it can be invested in. Like I said, they're all typically based off of the S&P 500. And the reason why they have these long names, 1-year multi-index monthly average index interest strategy, is because they can't get below zero. They have to earn at least zero, and then they're capped at something. And each one's maybe have different caps on them, but you could choose from different investments. Okay, here's an uncapped one, and I believe they're illustrations. This is the minimum and maximum illustrations. It's not your interest rate. So this one, the index strategy, is a floor of 0 and a cap of 9.5. So whatever the market does between 0 and 9.5, you get it. Anything above 9.5, you don't get, but you don't take a loss if it goes below. Here are the different strategies side by side. Where's the uncapped? Here are the maximums, illustrated values. Here's the 30 historicals. This one cap rate is 12.5. This one's 14.75. This one's uncapped, but it may take a loss. That's what this 10% means. All right, so they'll cover losses up to 10%. Let's see. These are just illustration numbers. Here's your surrender charges. This one's only 16 years that you have to have your money in before you can take it out. Let's see. If you pass before the 16 years, they will pay out the life insurance. All right, that's summary. Let's look at the actual illustration. They make you sign these, of course. All right, so they're putting in 50 every year. This is the male, 61, female, 54. Here's the accumulated values. And here they stop paying after 10 years. Net benefit is they still get their $3 million because it's called a paid up policy. And see where the value in the account hits a peak and then starts reversing. That's that graph I showed you where it runs out of money. But because you already put in all this money, they have to guarantee it, because that's the contract you sign. Is if you put in $500,000, then we will cover you for $3 million. And this is till this one goes until they're 81. So they put in $500,000, and it only covers him for 20 years for the $3 million. That's the difference between a whole life and a universal life. Is when the cash runs out, your policy runs out. Period. Okay. Let's see. The younger insurers only cover till age 74 till it runs out of money. All right. Here's one where the accumulated value actually makes better interest. So you can see the cash value on this 500,000 is actually going up, and it peaks at a different point because of how good the interest is doing, how good the investment is doing. And then this one will get him to, if the market outperforms, it'll get him to age 90. Um, and then this one will get him to age 120 if it does really, really well on this side. This is incredibly well, and this is just an alternative. I believe this 2.75 and this one is 6, if I'm not mistaken. So again, it all depends on your, all depends on how much you're funding it. If you get to, let's say you get to here, you're 86, and you got 640,000 in there. Run a new illustration, see how far this 646,000 will get you. If it only gets you, to 95 and you're still in good shape, you may need to fund it more. Or if you're over here and it's been making really, really good interest, 1.4 million, then you may be good and you could stop paying. So these you have to stay on top of and make sure that they're properly funded and they're not going to lapse on you. Again, 3 million is a huge policy. Like I said, the only time you need maybe permanent life insurance is for a cash infusion in order to get your beneficiaries the assets without losing the estate. Okay, if you don't have any assets to get to, then you may want to do a bigger life insurance policy, but again, you're going to pay for it, and you might as well start accumulating assets instead of doing the life insurance policy. But again, all these life insurance policies are based off of health screenings. Like I said, you want it based off of your health screening so they don't give you the worst case scenario. Okay? Again, these are preferred non-tobacco or preferred plus. He got preferred, she got preferred plus. She's in really good shape. Okay? If they got standard, they'd probably pay a little more. If they got standard tobacco, they'd be paying probably double. So get in shape, get that life insurance policy in place,